All right, let's dig into something that affects every single one of us. The weird, fascinating, and sometimes totally frustrating psychology behind our money. We're going to unpack why our brains, these incredible supercomputers, can sometimes lead us to make some, well, pretty baffling choices when it comes to our finances.
So let's just start with a question that I think we can all feel in our gut. I want you to really think about that sinking feeling of losing $100. Maybe it fell out of your pocket. Ugh. Now compare that to the buzz of finding $100. For pretty much everyone, that pain of the loss is way, way more intense than the joy of the gain. And this isn't just some random feeling. It's a huge clue to how we're wired.
We've all been on this ride, right? You're checking your portfolio and you feel that jolt of pure panic when the market dips. Or maybe you get a little too carried away when things are going great. This emotional roller coaster is a totally universal experience, but really understanding the why behind it all, that's the first, most important step to getting off the ride and making smarter calls.
Now here's the thing you have to remember. If you've ever made a bad financial move, and let's be honest, who hasn't? It doesn't mean you're bad with money. It just means you're human. The problem is that our brains are basically running on some seriously ancient software, an operating system that was designed for survival in the wild, not for navigating the chaos of modern financial markets.
And there's this whole field that explores these little glitches in our code. It's called behavioral finance. It's this awesome mashup of psychology and economics, and it gives us a map for understanding why we do the things we do, why we sometimes act completely against our own best interests, even when we know deep down that we shouldn't. And this quote right here, it gets to the absolute heart of the matter. It just perfectly sums up the biggest challenge we face. That sting of a loss is just a much, much more powerful motivator than the thrill of a win. This one little psychological quirk explains so much about how we behave as investors.
In fact, there's a name for this whole thing. It's called loss aversion. And get this, the research suggests that the psychological pain of a loss is about twice as powerful as the pleasure you get from an equal gain. Twice. It's one of the biggest, most powerful biases that's hardwired right into our financial DNA. This bias creates this really strange, totally backward situation. When our investments are up and we're in a position of gain, we tend to get super cautious. We get risk averse. We just want to lock in those profits. But what happens when we're facing a loss? Suddenly, we flip the script. We become risk seekers, willing to take on even bigger risks just to avoid the pain of actually admitting we lost. It makes no sense.
Of course, loss aversion isn't the only glitch in the system. Oh no. There's also good old overconfidence. This is our classic tendency to think we're a little bit smarter, a little bit better at this than we actually are. And in the world of investing, that could be so dangerous. It leads us to take on way too much risk, to ignore obvious red flags, and to trade far too often, which just eats away at our returns.
So you can see how these biases really warp our reality, right? We look at a stock that's been on a tear and our overconfidence kicks in telling us, oh yeah, it's going to the moon. We see a stock that's dropped and we get totally pessimistic, convinced it's a goner. We end up just chasing what did well yesterday instead of looking at what an investment is actually worth today.
So it really sounds like our own psychology is constantly setting us up for failure. But is that always true? A really interesting study took a famous bias from the world of, well, furniture and applied it to finance. And the results were not what you'd think. You've probably heard of the IKEA effect, right? It's the idea that we put a higher value on things we build ourselves. You feel more attached to that bookshelf because you're the one who struggled with the instructions for 2 hours. So the question is, does that same logic apply to our investment portfolios? If we do all the work to build it ourselves, does it make us irrationally attached and overvalue it?
Well, a group of researchers set up a pretty clever experiment to figure this out. They really wanted to see if the simple act of building a portfolio, not even customizing it, just assembling it, would trigger this IKEA effect and totally mess with an investor's judgment.
And what they found was wild. Yes, building your own portfolio absolutely increased the emotional attachment people felt. No surprise there. But, and this is the amazing part, it had basically no effect on how they valued that portfolio or on the trading decisions they made later. It seems the IKEA effect, which is so powerful with stuff we can touch and feel, just kind of disappears when it comes to our money.
Okay, so knowing about biases like loss aversion and these weird exceptions like the IKEA case is fascinating for sure. But what do we actually do with that information? How do we take all this knowledge and use it to protect ourselves from our brain's own worst instincts? Well, the good news is that we're not helpless here. The same research that identifies all these problems also points us toward real, practical solutions. We can actually build an anti-bias toolkit, a set of strategies we can use to bypass these mental glitches and make smarter, more rational choices.
I love this image because it makes the solution so clear. Think about it. On one side, you've got all your human psychology, the fear, the greed, all those biases. On the other side, you've got your actual investment decisions. The key is to put something in between them, to create a deliberate, rational filter.
And here are 5 of the most powerful strategies that make up that filter. This is your toolkit. Manage your emotions. Seek out contrary opinions. Be a renter, not an owner. Stop chasing yesterday's winners. And be very careful of crowded, overly popular trades. Let's just zoom in on a few of these.
Okay, first, managing emotions. This is all about recognizing that gut punch feeling when the market drops for what it is. It's just loss aversion kicking down your door. The goal isn't to not feel the fear. That's impossible. The strategy is to have a plan in place so you don't act on that fear. It's about taking a breath and looking at the facts instead of just mashing the sell button.
Next up, you have to seek out contrary opinions. Our brains are wired to want to be right, so we naturally go looking for information that confirms what we already believe. It's a trap called confirmation bias. The only way to escape it is to actively argue with yourself. Before you make an investment, make it a rule to find the 3 strongest arguments against your own idea. It's the best way to see the flaws you might be missing.
And finally, this is a really powerful mental trick. Think of yourself as a renter, not an owner. As soon as we feel like we own a stock, we get attached. It becomes part of us, and selling it feels like a personal failure. But if you think of your investments as just rentals, tools you're using for a while to get a job done, you create this amazing emotional distance that lets you make clear, unbiased choices.
So when you put it all together, it leads to this really powerful conclusion. For most of us, for most of the time, the single biggest risk to our long-term financial success isn't a recession or a market crash, it's the person staring back at us in the mirror. But, and this is the hopeful part, by understanding how our minds work and by using a toolkit like this to manage our own biases, we can turn that greatest liability into our single greatest asset.